All right, all right. What's up, everybody? Thank you all for tuning in to our virtual event, Alternatives to Venture Capital for Diverse Founders. As some of you may know, back in December, Goody Nation had a conversation about this in December 21. And you can catch it on Spotify if you haven't seen it already. But today's conversation, we're taking a deeper dive into alternative sources of capital. We're fully aware that venture capital may not be the best option for every founder. So we want to take the opportunity to talk more about some resources. And we have some very special people here who are going to talk about that today. We have our CEO, Joey Womack. We also have Justin Dawkins from Collab Capital and Mark Croswell from the Go ATL Fund. All right, Joey, I'm going to pass it to you.
Awesome. Thanks, Amma. So good afternoon, everyone. If at least you're in the East Coast, I'm Joey Womack, founder, CEO of Goody Nation. So as what Amma mentioned, this is the follow-up to our conversation on supporting non-unicorns that are diverse founders in 2022 plus. But today we're going to go a little bit deeper, right? We're going to talk a little bit more about the specifics and details around alternative sources of capital, especially for diverse founders. And so this is as kind of an extension of an initiative we have with National League of Cities, with Collab Capital, and with Invest Atlanta and others to identify awesome diverse founders, not only in Metro Atlanta, but across the country, and making sure they have the resources they need to achieve their potential. So a little bit of housekeeping. Please drop your questions in the chat. If you have any comments that you want to throw onto social media, please just tag us at Goody Nation, and we'll be sure to respond to you. So again, we want to see you active in chat, whether you're looking at us on YouTube or Facebook or LinkedIn or Twitter. Please post your comments, your questions here in chat. And yes, this will be recorded so that you can watch it a little bit later on. Now, as what I'm alluded to, we are joined by some awesome people, and there's no way that I could describe their awesomeness myself. So I'll allow them to do their introductions. And so first, I'll kick it over to Justin Dawkins from Collab Capital, and then we'll go over to Mark Croswell as well. Justin?
Thanks, Joey. Thanks, Alma, from great team at Goody Nation. Love to see y'all continue to grow and do well. Justin Dawkins, one of 3 managing partners at Collab Capital, where we're investing in Black entrepreneurs and innovators. We're really excited to bring a new capital product to market, which I think fits into the alternative category for sure. And so excited to be here and explore this conversation and make sure that founders have the resources and the tools that they need.
Awesome. Mark?
Thank you, Joey and Amma and Justin. Great to be on the panel with this group. Very excited. We've got the good fortune of bringing together philanthropy and private capital through our fund called the Go ATL Fund, which was hatched by the Community Foundation for Greater Atlanta 4 years ago. So we have some track record, primarily in a debt capacity. But the new fund we're rolling out is an economic inclusion fund specifically designed for BIPOC-owned small businesses and going direct, trying to really focus on a missing capital gap that has long been underinvested in the market. So thank you for having me.
Awesome. Now, everyone watching out here, you'll see people from Atlanta. A lot of us are based in Atlanta. To be clear, Atlanta does influence everything. Shout out to Bain. That being said, this conversation is applicable to a founder, anyone in the. So here's why we really wanted to do this particular session. I, in particular, talk to hundreds of founders a year. In many cases, and the founders watching this know that I will ask them about their origin story. So I do get personally kind of attached to them and wanting to see their dreams come true. And so it pains me. It pains me when these entrepreneurs experience a lot of frustration when it comes to raising money. They spend a lot of time. They're not focused building their company. In many cases, they're not able to get the financial resources they need, again, in order to reach their dreams. So being to think like, well, there's got to be another way, right? There's got to be another way. And we started talking around, different types of capital. And we found that many founders in particular aren't even aware of what's available to them. It's either, for most parts, it's either venture capital or bust. And we love our folks from our folks in the venture capital space. I'm cool with them. I sit on some boards and things of that nature. But again, it's not for everyone. And so I hate to see these founders go down these pathways that leads to a lot of anger, a lot of frustration, and ultimately a lot of failure. So I want to kick it over to my good friend Justin to talk a little bit about, to both of the panelists here, but we'll start with Justin on when we say alternative source of capital. Let's kind of define it a little bit more. How are you defining it, Justin, and what are some of the top types of structures that you see?
Yeah, so alternative, I think, is a very vague term, unfortunately, because it's already saying that anything that does not fit into a traditional box is somehow alternative. When in actuality, the capital markets have always been about alternative sources of capital, right? The alternative source is money you don't have in your own pocket, right, or your own bank account. So it's an alternative source. So friends and family is an alternative source. But what we've done is we've cultured that there's kind of a few buckets, right? There's friends and family. Some say friends, family, and fools money, the 3 Fs. And then there's banks and institutions, which is around debt typically. And then there's this thing called venture capital, which is very, very ambiguous. No one really knows what it is, but you see billions of dollars flowing through it to companies and entities. So alternative really focuses on anything outside of that, which can include grants and gifts. It could also include revenue-based financing models where there's a business is already actively operating and they get a line of financing based off of the money that they make. And then we see things like Shark Tank, right? So Shark Tank is, to me, an alternative source of capital as well, where you have a person or two that will come in, bring money and say, hey, we may do your purchase order financing and give you capital to grow your team, or get you into these places where you can start to distribute and grow your business. So, but the money is very similar. It's structured similarly. So it's always the investor that's pricing the round. They're pricing the value or putting the value, placing the value on the business, and then what they want in exchange for equity, which is really what venture capital is mostly about. But what we're starting to see is there's more fragmentation in the venture capital in the market that's not looking just purely at equity investing. They're looking at other, what we call alternative sources of capital. So that's how I define it. That's how I view it. And then at Collab, we really focus, our model is focused primarily on profit sharing, which takes us a little bit further down the balance sheet, the income statement, if you will, and really looks at building operationally effective and efficient businesses, and then sharing in the profits along with the owners or the founders of the business, depending on the type of business it is. So we can go into more detail around that in a little bit, but that's what I think when I think about alternative sources of capital.
Nice. So before I kick it to Mark for his thoughts on it, yeah, Justin, we're going to come back to you after that to talk a little bit more about profit sharing. But Mark, your thoughts on alternative source of capital and how we define
it? Yeah, thanks, Joey. Well, first, I want to talk about our supply of capital because that really influences how we think about using it downstream for driving small business growth. We come from the philanthropic world where our capital has by nature a social mission to it. So by bringing that into the equation, it's looking for returns on that which aren't entirely financial. So we are looking for a financial return, and we do want to see some kind of income stream on that capital. But we also want to see a social outcome. And a lot of times it's in this world, it's job creation, it's wealth creation by owners that typically wouldn't have access to that kind of capital. So that's really what drives our thinking. And then from the capital downstream side, we think of alternative capital beginning by taking off the handcuffs that have limited us in the past via traditional definitions of risk and how we associate that with different founders. We're trying to completely change that, and we've got good friends like those on this panel that are well ahead of us on it. But by bringing in those philanthropic dollars, we're creating the ability to generate alternative types that are different and missing in the market today. And for us, that falls in between the 3 Fs, the friends and family and fools money, and the more formal capital that could come from banks or CDFIs or from venture capitalists or angels, whatever the case is. So we're looking for that missing middle capital that goes to small business owners and ones that typically face barriers to accessing capital in the beginning. So we're trying to fit somewhere in between where you might find your uncle's money to get you off the ground and Justin's capital that may take you to the real growth stage. So that's our hope with this new fund.
Nice. So again, if you're watching here, wherever you're watching, YouTube, Facebook, Twitter, LinkedIn, wherever you are, drop your questions and your comments, but particularly your questions in the chat, and you'll have access to these panelists for another 50 or so minutes. So we expect some questions, and I'm seeing people logged in, and if you don't ask questions, I probably will call you out a little bit later on or something like
yes,
that.
It's looking a little dry, so I need y'all to come on, put the comments in there. Y'all got them for the next couple of minutes, so please.
We got some great comments and stuff, just not the questions yet. So maybe let's get into some specifics. And I think we'll have some questions from there. So Justin, I want to come to you to talk a little bit about profit sharing. So you dropped some great jewels there, but founders are like, okay, great. What does this mean for me, and how does it work? So can you explain this profit sharing and the model you all have at Collab Capital?
Yeah. So our space agreement falls into the category of revenue-based financing, even though it's not based on revenue, but it falls categorically in there because of where we actually get returns. Yep.
So define. You said space agreement. Can you define that? And then, sorry to interrupt.
No. I was about to dive right into it. So no, it's great. So the space agreement is an acronym. It sounds really, really cool. So that's part of the reason we like it. But it's called a shared profit agreement with a collaborative endorsement. And so the collaborative endorsement is a component of our agreement where we actually bring in what's called a growth partner into our actual investment structure. So if you think about when venture capitalists invest money, they offer support, or they are typically promising support, but we actually commit ourselves and bind ourselves to supporting our entrepreneurs that are on the space agreement. And we do that, and sometimes we bring in another partner, and that could be someone with subject matter expertise, a particular deep network to help them with sales, distribution, strategy, structure, things of that nature. And then the investment itself is there's a triggered. Hold on one second.
And while Justin is there, so we do see some great questions there in chat, and we'll get to those in a second. Justin?
So sorry about that. So the share profit portion of the agreement is structured. It's almost like a safe agreement. So if you're familiar with a safe agreement, it has these triggers in it. There's these conversion mechanisms that basically say, hey, I'm raising at this particular raising a particular amount of money with a valuation cap, or maybe with a discount, and it's usually pre or post money. And we can talk more about that in a second, Joey. But what happens fundamentally is, at some point down the line, usually based off of a next round of financing, that investment will convert into equity at what's called a priced round, or an equity round, where you're actually raising more venture capital, and that may be Series C, Series A, et cetera, et cetera, et cetera. So instead of those binary triggers, we actually have another trigger in our space agreement, which is basically a profit trigger, which basically means when you reach a certain milestone of profitability, so you're operating at a high level, you are profitable, because we can't take profits from a company that's not profitable, then there's a trigger that says you will start to return dollars to us via the profit share. And so that creates another mechanism and some options for founders. And that's what we really wanted to do with our agreement, was provide an alternative option, meaning instead of that boom or bust, as you mentioned earlier, Joey, it's like either give it venture capital, you're going to be worth $1 billion, $5 billion, $10 billion one day, or you're going to be zero to a venture capitalist. We said success should be measured in more than just those binary ways. And we wanted to give founders more choice and options as they grow the business that they ultimately want it to grow. And so that's the share profit agreement. And then there's the collaborative endorsement component that we can add and often do into our investment strategy.
Nice. So the questions are rolling in. I will say that I don't know. We maybe we can take one question. I want to kick it to Mark, and then we can come back to more questions later. So I don't know if you want to select one.
Okay. One question is, do companies who combine a combination of the two types of funding typically fare well?
Yay, my favorite question. I was hoping that this question would come up. It's all about the capital mix. And I don't know who asked that question, but it's a great question. So oftentimes when I'm talking to founders and I'm looking into their business and we're getting deep into diligence and really thinking about how we can be helpful, because we won't make an investment if we don't think that we can be helpful. We don't think that we're a good capital fit for them. We don't think we're a good investment partner for them. So one of the things that we do when we're going through that process is we go deeper into where is the money going to go? What's called the use of funds? And if there's a large portion of those use of funds are going to things like materials, or buying a physical good, or some sort of inventory, then typically growth capital should not be used for things debt is designed for. So then the question becomes, can we source debt? Can we source debt from a CDFI or from the SBA, right? There may be opportunities to get loans that we can then pair with growth capital, which is space agreement is the space, our space investments are considered growth investments as opposed to something sooner. We can then pair those two things together and say $500,000 in growth capital and another $500,000 in say debt from the SBA loan. And now they have $1 million worth of financing to spend on say inventory or buying certain assets or machinery, if you will. And then they have another $500,000 to hire people, build software and capacity building, right? And so it depends on what you're building. There is what we call the capital mix that you should really start to explore. Like when you look at that use of funds pie chart, if a large portion of the dollars that you're trying to raise is going to something that is going to eventually leave your business, right? Or has a value of its own, if it's going to be a machine where you turn the thing or you ship it out the door, you put it in a box and, it's going to someone's house, you're exchanging equity for a box. And that's not necessarily the right instrument. Very similarly, if you know you're going to be on a kind of rocket ship trajectory and you're going to be worth, and for a fact that you're going to be a $10 billion or you're going to need a lot more money than the check size that we can write, we would typically say, this is a classic venture capital model, or maybe you should look at revenue-based financing or some other instrument that was a better fit for where you think your entity is going, your business, your company. So yes, they do fare well. One of the challenges, a lot of founders don't know about the capital mix. They think they have to raise one way or the other, not realizing that, yes, you can raise money on different financing instruments that have their own terms and obligations, but they will give you I think a better outcome. And we're starting to see some of that. And so we don't have all the data yet. We need, more years of doing this and more deals done on like with this mix. But I do think that it will fare well in the long run for sure.
Nice. Before I kick it over to Mark, on some of the specifics around the investment structures there, just quick question: is there a link to the space agreement somewhere? And also, could you also say the acronym again? So acronym, and then is there a link to a sample agreement?
Yeah. So if you go to if you Google Medium, and I can share a link in just a second while Mark is going. But if you go to our website, we explain it there. You just go to our process page. There's also a great Medium article written by Jewel that outlines scenarios, which really gives you kind of a detailed walkthrough of like a map, if you will, like a company doing X dollars, raising this kind of capital, needs this kind of support, what a space agreement will look like. And so a space agreement can be said kind of two ways. If you say it all together, it's share, profit, and collaborative endorsement. Or you could say share profit agreement with a collaborative endorsement. So it just depends on how you want to say it, but they both work out really, really well. But it's a share profit and collaborative endorsement agreement is the original way.
Nice. Good stuff. Okay, Mark, I want to kick it over to you. I mean, so in terms of the types of investment structure you all are thinking about, I mean, you mentioned, I think what's super unique around the combination of impact investing and philanthropy. Could you go a little bit deeper into it and how you're thinking about things?
Yeah, thanks, Joey. So how we put together our structure that we're thinking about really came from our partners that we work with and that we have for a while, such as Goody Nation and Atlanta Wealth Building Initiative, Zane Access, who is another venture fund here that also provides acceleration services for small business. And many of these things that we're looking at were first informed by places other than Georgia or Atlanta. We learned a lot of this out of some of the conferences we go to. The West Coast has a number of funds that are developed around alternative capital. And what we found here in Georgia is that there was just no such other product. And so that really kind of kicked it off. And then the deep study that was done by Next Street and Atlanta Wealth Building Initiative, published a year ago around equitable capital gaps in Atlanta, took a real deep look at all the capital that is available for small business and what types are missing. And it even looked at the providers for that kind of alternative capital that tend to service other markets, but just aren't as available here in Georgia. And then some of those capital types were just what Justin is talking about, revenue-based kind of financing. So revenue share agreements, what I call flex debt, which is maybe a debt-based product, but it looks equity-like because of its repayment structure. It's designed to be much more flexible. So we're looking at a structure that may be a debt facility. So it may actually have a promissory note behind it, but it's going to be longer term, and its repayment is going to be based on cash flow and profit, much like Justin's at Collab Capital. Except we also, it's a totally non-dilutive product. The idea is that we're putting capital in there for some period of time for which they need it in order to get to the next step. We don't want to be there forever. We want somebody like Collab Capital to take us out. And sometimes we'll be in there with Collab because they'll be providing the big growth capital and the ones that can really help you through the longer term growth pattern. And this Go ATL capital can be there just to get you through a 3 or 4 year period, or to launch a new location, a new product launch or something like that. So we just want to fill gaps in the market that currently are not available.
Nice. So want to kick it back to, and again, so if you have any questions for Mark, could you drop your questions in chat? There's tons of great questions. Thank you all, because before we get to our next guest in about 10 or so minutes, we got to get through a lot of questions and stuff like that. But Justin, I want to kind of ask you, well, both of you all, this. Justin, I'll start with you. I mean, you kind of hinted at a lot of this stuff, but specifically, like, how can companies best position themselves for your space agreement and similar type of agreements?
Well, one of the things that great question, Joy. One of the things that I really, really encourage people to do is ask us more questions about the agreement. So feel free to send an email. We are building materials constantly. We're constantly trying to. It's a learning process. This is very experimental. Our LPs know that. We're still refining it. It's been through a couple different iterations at this point. So we're really excited to answer questions. We are a post product. So if you're still on a napkin, if you're still writing the code, you're a little too early. And we're post revenue. So we tend to, 90% of our investments so far have been post revenue, and the reason for that is we need to see a business model that we can then, we need to see an income stream, at least one, so we can actually start to figure out how we can help you widen the pipe, so to speak, on deal flow. If it's a B2B, like how we get you in front of more customers. If it's something that's direct to consumers, or if it's going to, directed at a particular people group, we need to be able to see what you've done so far and figure out how repeatable it is, so that we can put it into our math and get it into our equations, if you will, and make sure that we're a good capital fit. So we look for post product, post revenue. It doesn't have to be a ton. We're not like YC or some of the accelerators who say you got to have a minimum of 10K a month for 3-4 months. I mean, we've done deals with much smaller amounts of revenue, but we need to be able to see that this can be a profitable business as well. So with scale, yes, we understand businesses won't be immediately profitable for 1, 2, 3 years, but they can see profit down the line, and we can help them get there. Then that definitely sets you up well to have those conversations at Collab Capital.
Nice. So follow. I mean, I think so. So while last is there a minimum for MRR? You said like doesn't have to be.
Yeah, we just like to see consistency and some semblance of growth. So let's say January you had $500, in February you had $1,500, and in March you had $3,000. That's great. That's what we want to see. It doesn't have to be like, I wouldn't say there's a minimum, but make sure it's a model that is working well for you, and there's at least more than one customer, because you can have that kind of revenue with just 2-3 customers if what you're selling costs $500 a seat. But we just like to see that there's customers growing, you figure something out in the channel or channels, and that you're able to get throughput on those channels. You're winning deals if you're in head-to-heads, those kinds of things. So we look at the business model itself, your customer, and just want to see that there is actually a customer base there that wants what it is that you're producing.
Nice. So I want to kick it over to Mark. There was a question for you, Mark, before I get into some of the things that your actual, some of the details of what you're looking for. Barbara Jones over here is asking, is your loan program good for bridge funding in between venture funding rounds?
That's funny you brought that up. We just happened to speak to a company in the market here that Collab Capital is invested in. It's one of our proud Atlanta-based businesses. The thought of our capital, they actually brought up the term bridge because it could get them through the launch of a current round that they've got in the market to this next round that is coming up of financing. So absolutely could be used for bridge capital. We don't have any kind of prepayment penalty. Again, it's non-dilutive, so it's really simple. There's no valuation process. We may or may not be secured, or we want to look at partially secured. So the idea is we're going in flexibly. If we close a deal and you pay us off in 9 months, I think that's fine. So it's really designed to be what is most needed by the company and the founders.
Nice. And yes, as they've said in the comments, is the reason why we have this revenue over everything mantra here at Goody Nation. So Mark, before we go to another set of questions, could you go a little bit more into detail on terms of some of the things you're looking for? I mean, you kind of alluded to it before. I wanted to give you the opportunity to kind of share a little bit more.
Yeah, we're thinking of two different streams of capital need. One of them would be that what we typically think of as that missing middle, 75,000 to 500,000 in capital that is needed by really small business. Again, it could be a $200,000 or $300,000 revenue company, and then we have a second range of capital of say $500,000 to $1.5 million. That would be something that would be designed for a company with maybe a little bit more ability to scale, is still in the small business stage and has not yet gotten formal capital, but just needs more money. So those kind of the two ranges. And then as far as the company size, we're really not, we don't want to constrain ourselves too much. We would imagine most of our businesses would be under a couple million in revenue. We do want to see some path toward profitability. Doesn't have to be current monthly profitability, but cash flow projections in the next year are suggesting it's going to get there. And then if our capital is what's needed to trip the wire and get them into a more profitable position, and we can show that, then I think that's a justification we want to see.
Awesome. So before the next guest comes on, we actually have a few questions we want to get to. I know, Ahmed, you got a lot to choose from. So if you want to, you select some questions and kind of go from there.
All right. And also make sure you guys go into our shop so you can get the sweatshirt that Joey has. Okay, shameless plug. I'm going to go back up. I see one from Jawan Burton. It's kind of more like a basic question. For someone like me who is a software engineer with an entrepreneurial spirit, where do I start to educate myself on raising money, period? I find it very difficult to find a path to success when it comes to just finding solid information to guide me in the right direction. So maybe like just something basic for someone who's just starting out.
I can jump in there. I would say there's kind of, for the technically inclined, I think there's 3 ways that you can kind of learn more about the venture space. One is pursue a fellowship with something, there's lots of firms that offer fellowships and those are expanding. Collab is getting ready to launch one as well. So that might be a place where you can learn and get closer to investing itself and be a part of this space. And then you can figure out what's best for you from a career perspective and starting your own company perspective. So that's one. 2, there's a great book by Brad Field called Venture Deals, which is great. It's a great way to get a quick, fast, in a hurry. Like if you're willing to sit down over a couple of weekends and just learn about deal structures, where a lot of these instruments came from. It's a great source. It will not give you, it's not comprehensive by any stretch of the imagination. So you definitely want to make sure that you are keeping a curious eye and ear to the streets, if you will. And then I would say the third thing is ask questions. Get a mentor or an advisor in this space. Reach out to someone who's an investor, or maybe even take an investment. Maybe exit their firm. Maybe see if they're working on something that you can help them in. It may be, if you're a software developer, it may be starting up another company. Getting in maybe early there, but being intentional about being close to the investment side of the business, learning how they're pitching the business, how they're presenting it to investors, and then also how they're determining what type of capital, how much money they're trying to raise. Those aren't necessarily all easy paths. I think reading a book is probably the easiest one, but there's definitely options out there, and lots of other firms I know there are a lot of other organizations that focus on access to capital, and they have great resources and programming. I'm none are coming to mind, just 'cause I have a lot in my head going on, but there's lots of great firms out there doing awesome things.
Yeah, that was great. Joe, do we have time for one more question or? Okay. I'm not sure how to say this, but AI consulting, they are saying there's a hyper focus on scale in the VC space that isn't conducive to the social mission of some companies. What is the best structure for some of us who are focused on a slower paced growth? Mark looked like he want to answer it.
Yeah, well, when he brought up venture capital, I said, well, Justin needs to take that one. No, I think it is one for me. So I would say that describes the capital we're trying to put together. We're not looking for necessarily the VC path type company, or the one that wants to end up in Silicon Valley. Main Street businesses, ones that are just providing your basic needs services, I think are just fine. We really have no sector specific areas we want to focus on. And if we're just talking about marginal growth, and as long as we see employment base continue to pick up, and that's healthy, living wage kind of employment, and it's creating wealth for the founders, that's good. That's good enough for us. And again, our capital is designed not to infringe at all on the founders' equity in the business. It's just designed to get them to the next level.
Nice. We have some very specific questions that I can follow up before I bring up our next guest, and then we'll have another set of questions near the end. Justin, is there a certain type of founder you're looking for? Is it for BIPOC founders or anything?
Great question. And I also want to make sure I did not make this clear about the space agreement. I think it's important. Mark, you triggered this thought for me, so thank you. We have a mandate. It's actually written into our operating agreement, into our thesis. We are investing in Black-led startups. So there's at least one founder with what we consider to be an equitable portion. It does not have to be majority share. We understand founding, team structures can be dynamic. You can have 4 people and one founder can be Black. We just want to make sure that there's an equitable representation. At least one of the founders on the team is a Black person, or considered Black or African American. And then so that's to answer that. And I think we're one of the largest funds specifically built and raised capital of this size to invest in Black entrepreneurs and innovators. And here's one thing I wanted to say very quickly, Joey, is that our investment vehicle isn't what we call an or vehicle. It's not an and. So it is, we either end up in equity, right? So we convert into equity at a priced round when you go and raise your Series A, as an example, or you trigger the profit share and you return capital via the profit share. So that's an important distinction that sometimes founders think we're doing both. We're taking equity and we're doing a profit share. That's not the case. It's an or document. So it's a conversion, if you will. You either convert into profit share or we convert into equity. So
nice.
Just want to make it clear.
Nice. So I'm gonna bring the next person to the stream. But while we're doing that, Mark, I want to ask you a question around geographic preference or restrictions. Are you open to founders from across the country? Is it Southeast or what?
Yeah. So far in our legacy fund, the one we started 4 years ago, we've been Metro Atlanta focused, and we have some of that capital that spills out into the rest of Georgia. We're going to be a little bit different in this economic inclusion fund. We want to focus on a preponderance of our capital being in Georgia, but we're changing up the definition of what that means. So as long as there's a significant business presence in Georgia, or significant level of employment, or founders that are based in Atlanta, then that's enough for us. And so the companies can be based elsewhere. We just want it to show that it somehow is benefiting the Georgia market.
Nice. Okay, so we have another guest here. So hopefully, Justin, Mark, you can hang on for a few minutes. We have another awesome guest here, again from Atlanta, because Atlanta influences everything. So I want to bring her up to talk about just a quick intro before we get into some questions. So Lexi, want to kick it to you for a quick intro.
Awesome. Thank you so much for having us. Hey, everyone. My name is Lexi Newhouse, and I support our innovation and entrepreneurship efforts at Invest Atlanta. Invest Atlanta is the City of Atlanta's economic development agency. So we do a variety of things, anywhere from community development with affordable housing to workforce development through WorkSource Atlanta. And then, of course, our economic development initiatives, which include business attraction, retention, expansion, small business, and of course, innovation and entrepreneurship. So I guess that's at a high level what we do. We could get more into the specifics of how we help provide access to capital for our local entrepreneurs and innovators, but I can wait for questions.
Yeah, no, that's really the next question. So we had some great conversation, had a great conversation earlier around different types of capital for founders. The common thing here is revenue over everything. And so I want to get into the specific ways that you all are supporting entrepreneurs with capital and maybe some other opportunities.
Yeah, so we're really at, I hate to say the word, but an unprecedented time, right? So we've received, as the City of Atlanta, as Invest Atlanta, huge allocations of federal COVID-19 relief and recovery money that historically organizations like us have never seen. And so that's, the beauty of being able to hand that money to our local entrepreneurs, whether that's through our Resurgence Grant Fund or some of the other upcoming programming that we're going to have as part of the American Rescue Plan allocation that we've received from the city. So access to grants is one of the many ways that we offer access to capital. And of course, grants are hugely favored, right? So for all of our Atlanta entrepreneurs that are joining us today, the Resurgence Grant Fund is reopening on March 1st. We have webinars up on our website. We have resources on how you can apply. The beauty of this round of Resurgence is that startups, home-based businesses, nonprofits are eligible, and they weren't eligible the first round. So take advantage of that now and continue to keep an eye on some of these COVID-19 relief programs that we have coming up. So that's kind of unique to the times, but in terms of the programs that we offer ongoing, we have a fairly large small business loans portfolio, two of the products that are specifically designed for startups. And that's our Atlanta Forward Loan Fund, which offers up to $20K with a 2% fixed interest rate, as well as the Community Loan Fund, which is up to $50K with a 3% fixed interest rate. The beauty about the Community Loan Fund is that $30,000 of that can actually go towards paying off high interest debt, towards working capital. And we haven't seen many other cities or economic development agencies be able to offer these types of loan products to startups. We recognize, we're not a bank. We're able to take on more risk. And we want to be really intentional with the type of entrepreneurs that we're supporting with this capital. So, prioritizing underserved and underrepresented founders. So grants, small business loans, and then of course we have the variety of economic incentives and certifications through the government that you all should be taking advantage of. But unfortunately, not enough people know about them. But I can dive into that later too.
Yeah, that's my next thing. Also, I want to talk about if there's any other opportunities to do business with the city or something you can kind of maybe even allude to. So before we kind of go into those incentives and other opportunities around the city. So again, if you're not from Atlanta, you may be like, oh, okay, well, everyone's from Atlanta. This is not necessarily applicable to me. But it's what Lexi just described. I might imagine that there's a version of what they're doing no matter where you are in some way, shape, or form. So if you're watching and you're in DC or Miami or wherever, I think this is an opportunity for you just to kind of poke around, do your own research about what opportunities are available in your particular city or area. So let's talk about some of those, incentives. And then I also want to go to after that around what type of opportunities may be available with the city itself.
Exactly. Yeah, Joe, you nailed it. We're the city of Atlanta. There are other cities doing the same as us, right? Even at the state and federal levels. So startups that aren't involved with their local elections, aren't involved in their government, start doing that now. They have a huge influence over the type of capital and incentives that you'll have access to. So build out those relationships with your local governments and economic development agencies. So some of the economic incentives that we offer, for example, is the state opportunity tax credit. So that is a state of Georgia funded program that provides up to $3,500 per employee for 2 or more jobs created within specific zones of the city. So the beauty about this program is that it's literally a one-page application. And I'm sure we've all dealt with government, we've all dealt with applications. This is one of the most straightforward applications that I've seen. And so if you are located within one of these opportunity zones, which you can find on the Invest Atlanta website, you'll work with Invest Atlanta to submit that application and then await an update from the state. So fairly straightforward process for all those that are creating 2 or more jobs. I think really what gets me most excited, and I think it needs to be prioritized with access to capital, is ultimately access to customers. So people that are going to come back, they're going to continue to pay you. It's not just a one-time grant or loan. So what we are looking to revitalize is the Atlanta Demonstration Project Initiative, which was a piece of legislation passed back in 2013 by Council Member Andre Dickens, who is now the mayor of the city of Atlanta, that allows Invest Atlanta to facilitate pilots and contracting opportunities between the city of Atlanta and local startups. So, you know, the city can be one of those initial customers and help foster those relationships. And I think that's really where the value lies, is being able to offer those types of piloting and procurement opportunities, especially with government entities. And startups that think, oh, I'm not going to do business with the government. There are so many contracting opportunities, whether that's food vending, whether that's tech, transportation, logistics. There's several use cases, I'm sure, for startups like yourself to be doing work with government. So like I said, that piece of legislation was passed in 2013. It's been a minute since we've done a pilot between our Atlanta startups and the city. We're looking to get that revitalized in 2022 to help offer those initial pilots with the city and then support entrepreneurs to pursue larger contracts, whether that's at the local, state, or national level.
Nice. So you should be dropping questions in chat here. Lexi's the type of person, I mean, she'll probably won't say it, really super smart, but also super busy. So amazing opportunity to ask some questions there. So if you've been watching with us since the beginning, let me just make it abundantly clear to you. So you first set of conversations are really around access to capital, and then these capital providers are looking for revenue. Lexi's talking about how you might generate revenue by doing some pilots with the city. And so even taking it a step further, if you were to do a pilot with like the city of Atlanta or New York City or the city of Miami or insert city here, you get one of those logos on your website. You start to demonstrate you can do value. You can then take your company pretty much to any other city. I mean, it's not a guarantee, obviously, but it opens a lot of doors for you, which generates more revenue, which puts you into better opportunity categories for people like Justin and for like Mark. So this is how kind of it all plays together. So we're trying to kind of give you a pathway here, not trying to give you everything. Still got to do your research and stuff like that and hit certain milestones. But this is a way we can start to hack, quote unquote. And for those that have been around Goody Nation for a minute and know our roots is Goody Hack, we can start to hack ways to develop more in larger and better diverse companies really across the country, but also here in Atlanta. So again, if you have any questions, please drop them in chat. I do think I can take this question. There's someone that on LinkedIn that says, can you do business with the city of Atlanta if they are based in North Carolina?
Yeah, that's an interesting question. And we even get that locally. So and you know, if you've been on Twitter, you've seen this, right? So what is actually the city of Atlanta versus Metro Atlanta, right? So even just within this what 26-mile radius or whatever it is, or 26 counties, we get that question, right? So going beyond the state, there are opportunities. Now, if we were to do a pilot, we would want to be looking at our local Atlanta founders here, but there are separate opportunities through the Office of Procurement at the city, where I'm sure they, you know, depending on the needs of the RFP or the RFQ, and they have to look and expand that radius to get some potential vendors. So, you know, I'll just highlight it on that too. On the piece of government is that those government entities typically have an Office of Procurement, and they typically have certification. So for the city of Atlanta specifically, there's an equal business opportunity certification as well as a small business opportunity certification. Usually there's no cost associated with getting these certifications for your business. And the beauty of having those is that it increases your chances of the city looking at you because they know that you've gone through this process and that you are registered with them. So regardless of whatever city you're in, take a look at that procurement office, see what certifications they offer and what sort of training options they have as well.
Nice. Are there any with the city of Atlanta in these pilots for the demonstration project? Are there any certain sectors or certain types of pilots you're looking at? Or I know I believe it's still early, right? Or it doesn't matter? Are you sector agnostic?
Yeah, no, that's a great question. So, and when working with federal funding, so we've been super fortunate to receive 2 grants from the Small Business Administration as well as the SBIR. So for SBIR, they are a little bit more STEM focused. So we see a lot in like renewable energy, transportation, logistics, industries of that nature. However, I think, you know, in terms of being inclusive and equitable, we have to show that there are opportunities outside of that. So, for example, I mean, take the department or Parks and Rec, for example, or local school systems where they may be looking for after-school programming or tutors or things of that nature, right? So there's an opportunity that is not just STEM focused where they can offer that type of training through a pilot or those types of services. So for the purposes of our grants, we may have to be a little more focused on those STEM industries, but know that we hope to expand this program just to be inclusive of really all the entrepreneurs that are here in Atlanta.
Nice. So we have about 10-ish more minutes left. Want to open it up to more questions. But before we do that, actually, I want to kick it to Justin and to Mark for just your thoughts on maybe how all this stuff kind of plays together in almost an ecosystem like way. Maybe there's no thoughts, but Justin, I'll start it with you. When you hear what Invest Atlanta is offering and doing, any thoughts on how that kind of plays together with some things you're working on, a lot of stuff in the ecosystem?
Yeah, for sure. I mean, we are always looking for distribution. We're looking for ways for our companies to get in front of more customers. Lexi hit the nail on the head. You can come and, you know, talk to us all day, but your greatest leverage is, hey, we've been able to get customers, and we just need to take your $1 and turn it into $5, and we can do that efficiently and effectively. So that's the goal. And you know, having the city of Atlanta be a partner, you know, one of your early reference customers, someone we can call and talk to and say, how's the experience been, goes a long way, and it makes it very easy for us to evaluate the business and the investment opportunity, but it also makes it very easy to talk to other investors that might be helpful in getting you know, penetration in other markets, which is another component of the National League of Cities, Joey, you know, the partnership we have there, which is how do we take the kind of the best of Atlanta, you know, export it, if you will, and then import it into other communities that may not necessarily have all the things that Atlanta has to offer, but we can bring the best things. And one of the things we can do is say, hey, the city of Atlanta is a partner, is a customer, is someone that you can call, and we can continue to lead both from an entrepreneur support organization, but then also from a city level. So yeah, really excited about what Lexi's doing, Invest Atlanta's doing, and really hoping to collaborate, no pun intended, pun intended, collaborate more going forward on getting founders and startups more opportunities for sure.
Nice. And Mark, I'll kick it to you before we kind of go to Amma for maybe about 4 or 5 minutes worth of questions.
Yeah, I was just going to point out, all the capital providers, and as they come on the market, it can be very overwhelming, and to try to reach out and do that all at one time is really difficult, especially when you're growing a business. So the value of just developing network over time, so that you kind of know who to call when the time comes up, is critical. And by the same token, associate yourself with different business groups, just so you're always aware of what is coming on the market. And that can be through the chamber, it can be through Invest Atlanta, it can be through community partners like Goody Nation, or it can, in Georgia we have the Georgia Social Impact Collaborative, which is basically ecosystem level provider of information and connection and education around impact investing. We work a lot with Invest Atlanta, and they have a history of taking federal and other subsidy dollars and turn it into capital opportunities. And they have a number of small business funds as well that can be accessed. And so I think they're a great partner here in Atlanta, and I'm sure there's something similar in other cities. But you'll kind of always, as a founder, you always have to be in the market. You're never out of the market. So I think that's the way I would think about it.
Nice. Nice. Amma, we have time for maybe 1, 2 questions before we close it out.
Okay. One question is, for startups with a focus on economic development and creating affordable housing in the Metro Atlanta area, what programs, I guess it's for Lexi, what programs, grants, or incentives would be available via Invest Atlanta or from the state?
Yeah, so okay, that's a little bit more on our community development side, but I can certainly connect that person to the appropriate teams. But I mean, it's true. A lot of entrepreneurship is focused on property investment and community development. So we've launched programs for those more local developers that are looking to create affordable housing in the city, and recognize that those smaller local developers are crucial to creating community and affordable housing here. So can certainly connect you to the teams that oversee those programs. We have pre-development loan funds. We have a variety of incentives that can be used. So I can send that your way.
Okay. Just want to make sure, did we already go over this? How long does it typically take to do a deal with a new space partner or go ATL financing?
I can answer for Collab on the space agreement. It can vary. We've done deals as quick as about 4 to 5 weeks, I would say, on the lowest end, up to about 7 to 8 on the top end, typically. A lot of it has to do with how we build our playbooks, and we get really, really intentional. But there's also the reason for that is, again, we want to make sure we're the right fit. We try not to make it, totally the most laborious task for founders. We try not to burden them with it. So we do a lot of digging ourselves into their market, figuring out how we can help with sales and things like that on our side. And then we come back to the table with the deal and the structure that we want to put together. And then we then there's always negotiation and legal. We have a fiduciary responsibility to do all kinds of legal and financial backgrounding, just make sure that the company's in good standing at whatever level, sometimes city, state, and the federal level, of course, and then what kind of debt they may have. So that takes some time just in general. So that's probably like 2 weeks of it, 2 to 3 weeks of it. And then the rest is really us digging in with the founder to figure out if we're a good fit and finding the right dollar amounts and equity alignment is what we call it. So.
Thank you. Mark, did you want to add? Okay.
Yeah, I would point out sort of a similar timetable here. If you're at the point where a term sheet is being developed, that can go relatively quickly. It can be 3, 4, or 5 weeks to actually get a deal closed, and our documents are pretty streamlined. I would say the less defined period is that which leads up to getting a term sheet in place. It's that cultivation, that runway that development of relationship that takes place, and that can be months, it can be years. It really depends. We're about to approve a deal this week. We finished up a term sheet at the end of last week, and then we'll probably once we get it approved this week, we'll probably get it into closing and done within 30 to 45 days. But it's all that work that happened prior to last week that is so hard, and why you just simply have to always be in the market.
Nice. So this has been an amazing conversation. We have about 4 minutes left. So I just want to go around the horn just for final thoughts and also contact information. So we'll go Lexi, then Justin, then Mark, and then I'll close this out. So Lexi, any just final words, and then how might people either get in contact with you or Invest Atlanta?
Yeah, thank you so much for having us again. We appreciate it. So feel free to reach out to me at lnewhouse@investatlanta.com. You can also take a look at our website, investatlanta.com. You can sign up for office hours with me there. And then you can also see our Deal Room Startup Investor platform. It's free, open access. There's a startup investor matching tool. More importantly, though, we've seen a lot of startups be able to take advantage of it to help source clients. So take a look at that, and I'll keep an eye out on my email for any further questions. So thanks, Joey.
Awesome. Justin?
The big thing I want to say is thank you, Joey, Alma, for a great conversation. Be encouraged. That's the big thing with founders. As Mark already pointed out, it can be a long process. I always say you're always in market because you never want to have to raise money and be asking for investment when you need it the most. So start those conversations early. Introduce your business. Say, hey, I just want to send you updates. Here's the space. Is this something that may align with collab down the line? Even if fundraising is down the road, that's actually a much better place to start those conversations. So be encouraged. Definitely learn. There's lots of options out there and lots of learnings as well. So again, tap into that network as best you can. Lean on the good folks over at Goody Nation, like Joey and Alma, to align you with folks that may be helpful in helping you in your journey, and then getting you to the point where when you're ready to raise capital, you're most well equipped and with the right information. So thanks again, Joey, Alma, and the rest of the panel, Mark and Lexi, for your time. This was great. Thank you.
Awesome. Mark, final thoughts on how can people get in contact?
Yeah, I just got to say a big thanks to Joey and Alma and the whole team at Goody Nation for bringing this group together. I've learned a lot. I've learned a lot from Justin. He'll be getting a note from me pretty soon about buying him coffee. Lexi, same with you. We've got great partners here in Atlanta. I would just say feel free to reach out. Hopefully my info gets copied to the chat board out there, but I'm at mcrosswell@cfgreateratlanta.org. Always happy to answer questions if we can do it for anybody. You don't have to be in Atlanta. And associate with your local business support organization, your accelerator program, incubators, co-working environments where they're bringing together founders. Peer networks are maybe the most valuable thing out there. So you got to be in the market, not just for capital, but for friends and network as well.
Nice. Final thoughts.
This was such a great panel. All of you are such invaluable resources to the community. So I'm super excited for the founders who were able to listen and those who catch the recording. And yes, at Goody Nation, we are dedicated to the 360-degree development of founders. So super excited for what's in store.
Awesome. So we try not to do a ton of events. We want you all to go out there and build. And if you're supporting entrepreneurs, you're supporting them. But we felt like this was an important topic to have. Just know that we'll be having even more detailed conversations and initiatives moving forward. A few quick notes. Thank you all for submitting a ton of questions and comments. We didn't get a chance to go over all of them, so we'll take a lot of these comments across YouTube, Facebook, Twitter, and LinkedIn and send them out to our panelists for additional answers, and then send them out to the rest of everyone or make them available on our website. So thank you all from the hearts of Goody Nation. Go out there and outwork yesterday. Stay magnetic, and just remember, revenue over everything, people. See you all later. Peace out.